I'm Charlotte McLeod with the Investing News Network, and here today with me is Paul Robinson, Director of CRU Group. Thank you so much for being here online with me today.
It's great to catch up, Charlotte. Hopefully in the future, face to face, but this is a fantastic way of doing it.
Yes, usually we do see each other in person at PDAC, but of course, like many things, we're online this year. I think I will pick up from where we left off last year at PDAC. We usually end up speaking there. I remembered you mentioned that it would be really important to watch how the COVID-19 situation played out in China. So I wanted to ask, ultimately, what did we see and what impact did the measures China introduced have on the commodity space?
So what we saw in China was a very firm lockdown, firmer than we saw in the West to really neutralize the spread of the vaccine. The spread of COVID as quickly as possible. And what we also saw, which was one of the things I said to keep an eye out for our sector, was that stimulus in Q3, Q4. So you had that combination of the stimulus. The firm lockdown, which I think gave the Chinese the Chinese people confidence, and of course, on a relative basis, you also saw a lot of confidence from Chinese people in their government in what they did, and that also drove the consumer confidence in Q3 to Q4 to spend money and sort of help the Chinese economy and also help the broader commodity sector. Specifically, what we saw more in a more emphasized way because of the nature of the Chinese economy, we also saw a release of that sort of pent up construction demand in particular, which was great for steel and iron ore. But as I say, generally a strong lockdown, consumer confidence in the government, and then strong broader recovery that's helped all of the commodities in H2 2020.
Yeah, and maybe you could talk a little bit more about that H2 2020 recovery in the commodities, because from my understanding, it was quite broad and across the board.
Yeah, you're quite right. It was broad. It was across the board. There were a couple of drivers. So if you look at it from a demand perspective, demand wasn't brilliant, but we had such low expectations in the first half that sentiment changed from being sort of a disaster scenario to, gosh, it's not as bad as we expected. And so there was enough demand to create some positive sentiment. On the price side, that price was supported by better demand figures. It was also supported by money more broadly coming into the sector, because on a relative perspective, again, commodities performed relatively well compared to retail or housing or airlines, holidays, a whole bunch of sectors you could talk about. And from a supply perspective, there were two important issues. One, as an industry, we had already gone through some of that rationalization and that sort of sensible allocation of capital on a supply basis. So even before the crisis, there weren't the same supply overhangs that we saw during the GFC. So that meant there was less of a gap there caused. And of course, one of the things that the mining sector benefited from was the drop off in FX and the drop off in oil prices, which meant the cost of production fell quite significantly, which meant margins by the end of 2020, if you were producing, margins were actually higher than pre-COVID levels. And that supports debt, that supports free cash flow, that supports stock prices. So it becomes a bit of a virtuous circle.
All right. And after that, maybe surprisingly positive second half of 2020, what are we looking at for the commodity space in general as we are now moving into 2021?
So that sentiment has grown, if you like. So as we went through H2 2020 and into 2021, you've got further positive sentiment. You've got, if you like, vaccine recovery, positive sentiment, particularly here in the UK, in the US, to a certain extent in the EU. So there's the base case now has an expectation of some consumer pent-up demand being released in at the back end of H1, H2 of 2021. You've also got the Biden stimulus, I think $1.9 trillion stimulus, which is, not an insignificant number that's going to, a lot of that will feed through to commodity demand. You've got certainty on the Chinese numbers. And then you've got the added benefit of the potential for even more to come at COP26 later this year in terms of the stimulus and Green Deal and sort of energy transition. So I'd say there's a lot of assumptions baked into the current pricing. So if you like, we've moved from a year ago where there was a lot of there were a lot of negative assumptions driving the price down, to say that we're probably fully priced at the moment until some of these assumptions turn into action. But it's a very credible case to have that consumer recovery and the stimulus and the potential of further energy focused stimuluses towards the end of 2021. So a good position overall, I'd say.
Right. And looking more specifically at commodities, I know every year at PDAC, when you do your presentation, you have a chart that shows which ones are going to be hot, which ones will be not so hot. So what's at the top of that list in 2021?
So the top of the list of 2021, some of the more well-funded commodities, it's linked to battery metals. So copper is near the top, nickel is near the top. We still see strength in specifically US steel prices and US aluminum prices, and that's around the restrictions on trade in and out of the US for competitive products. But the battery metals, the precious metals are still doing relatively well, but they're not. Gold is no longer number one, which it was a year ago. It's still a safe. It still has safe haven value. But battery metals, some precious.
Right. And interesting you mentioned copper and nickel as battery metals, because I know they have other more traditional uses as well. So where are the lithium and cobalt, things like that we might usually think of when we say battery metals? Where are they in the picture?
I think cobalt is top 10. And again, cobalt has some fundamental challenges we've talked about for the last 2 or 3 years, which is there remains a restricted supply. It's very much focused in the DRC, and it's often mined as a byproduct. So you've got to have more than one positive outlook to sort of drive that cobalt investment. Lithium, we think, again, medium term, all the battery metals have a positive outlook, but this year we're still not as convinced that the strong spot rally we've seen at the beginning of this year in lithium is as sustainable as cobalt or nickel. So it's sort of a mid-league table sort of prospect for 2021, but stronger again into 22, 23 going forward.
And for copper and nickel, does that mean we should be thinking more about the battery story when we consider those metals? Although I know many people are already thinking that way.
So certainly on the nickel side, that's the thing that's driving the sentiment at the moment. People forget how strongly correlated the price remains to stainless steel, and so we would expect volatility in nickel because stainless steel demand and is less correlated to IP industrial production than raw steel demand is, because there is a lag there. So there will be some volatility on the nickel side, but primarily, its use in the electric vehicle sector, that's what's driving the driving the sentiment and driving the price beyond, or will drive the price beyond current levels. Copper, it's more about energy transition, so it's not just electric vehicles, but it's the greening of grids, it's the it's building of wind turbines and other renewable forms for motors and other electrical parts within there. So it's that combination, and I think copper, for me, stands to benefit quite a lot if we see the sorts of green infrastructure plans that are being talked about both in China and in the US. But again, I think for me, you need to see the firm policies that actually show that investment dollars are going to take place to get the next kicker on copper prices. So again, like nickel, I'd expect volatility for the remainder of this year while we wait to see whether these announcements and policies turn into firm dollars, firm investment, and a firm demand for those commodities.
Okay, that helps put it into perspective, I think. I want to touch a little bit before we move on gold and silver, which I know our audience has a strong interest in. People are feeling a little bit, I think, disappointed by the price action so far this year. What are the drivers we should be looking for there in 2021 for those two metals?
So again, well, I mean, we think gold and silver from a fundamental perspective is fully priced. There's probably, there's probably more volatility in gold to come. So again, when we're at PDAC a couple of weeks ago now, we were at the current peak of sort of vaccine optimism. And everything was going to go very well, and therefore gold was suffering. And I think I said at the time that there will be ups and downs on the vaccine rollout. Right now, Europe is suffering a sort of mini crisis of confidence in terms of the EU, in terms of being able to roll out its vaccine program as effectively as it wants to, and that will have a negative impact on sentiment, and that will be supportive of safe haven status like gold and silver to a certain extent. And so I think there will continue to be volatility. I think the other point to make with gold is that we still need safe havens, and so I think there will be again upside on gold. I think it's pretty certain that we're going to get that demand boost, that consumer confidence in 2021, that sort of pent-up demand. It's far from clear yet that we're in that we've got a sustainable economic recovery on a global basis in Europe, in the US, and what the world looks like in 2022, 2023. Although I'm personally positive, I think there's a lot more uncertainty about how sustainable that demand is beyond this calendar year, and therefore there's a place for gold, I think, in people's portfolios just to hedge against that risk.
All right. Now, I don't like to be too negative, but I think we should take a look at what commodities came in at the bottom of the list and what put them there.
To be honest, there isn't a lot at the bottom of the list. So if I give you a context, and you just forgive me, if I give you a context, I think if we go back to 2020 on an annualized basis, something like 31 of the 38 commodities that we cover posted a year-on-year annualized price decrease. So this was 2020 over 2019, I should say. If we're looking at 2021 over 2020, we're looking at 35 of the 38 commodities registering a year-on-year price increase. So they're all winners. It's just a question of on what relative basis. To answer your question though, then it's those that are more carbon intensive. So metallurgical coke, coal we see as more negative. Manganese ore we've got as actually our worst performer and falling by about 15% this year. That's a pure supply issue thing. So it just happens to be in a different part of the cycle to other commodities where there is plenty of supply and there's plenty of additional capacity at the moment. So a bit like the oil market, we feel there's a natural cap there until they get through some of that supply overhang. But actually what I would say is across the board, we're seeing price appreciation for the commodity space. And importantly, for most of them, that price appreciation remains behind cost appreciation. So again, it's another good year for margins, another good year for free cash flow if your exposure is via equity rather than or debt rather than the commodities themselves.
All right, so 35 out of 38 commodities that you're tracking expected to register a year-on-year gain this year. What does that tell us about the space overall? Is there a comparison point that we could perhaps make to a previous time when we've seen something like this?
So it tells us a couple of things. It tells us that from a market expectation perspective, we were overly cautious in terms of the downside of or to our sector in 2020. So there's a snapback recovery here. It wasn't as bad as we thought it was going to be, and now there's a recovery. I think more than that, there's talk of a super cycle, which is maybe what you're alluding to, and there's talk of people saying maybe this is the beginning of the next super cycle. We're not convinced we can make that call yet, but certainly, if I'm sat here in 3 years' time and we've got this this pattern for 3 years, I'll be having to apologize to say, well, we got it wrong that time. Well, maybe
All
not
right.
apologize, because people will be quite happy.
Okay, so we'll wait and see on that one. So as we move into this year, it sounds like we're going to be probably continuing to watch China, watching what goes on in the US with Joe Biden now as the president. What other elements should investors perhaps be keeping an eye on this year?
So I think, like you say, you definitely need to look at China. I think in the immediacy we've had, we expect protectionism to continue to be a trend across the world, and we've seen that with, with a continuation of President Trump's policies towards aluminum and steel imports into the US. So again, we'd expect to see protectionism. I think the other things to look forward to, or to be I was going to say be wary, but there's opportunities there as well, is to look at this new review in terms of supply constraints and security of supply of raw materials, which we will find out more about this year. And of course, as I say, the big COP26 conference in Glasgow later this year. I think they're the two big triggers to look at this year.
All right, perfect. One final subject that I do want to touch on, because it came up in your PDAC presentation, and really it's coming up in many places in the mining industry right now, is ESG, which I think that you mentioned that for investors right now, if you are not considering ESG when you make your investments, that's actually a risk that you're taking on to not think about it. And I hadn't heard it phrased quite that way before, so I wondered if you could talk about that a little bit.
Yes. So one of the points I was making, we ran a survey with Fitch Ratings, and we ran a survey and we asked mine operators and owners, and we asked investors what they were most worried about and where they saw the most uncertainty over the next, I think it was a 3 to 5 year horizon. And there was absolute agreement that the most uncertainty is around ESG, particularly on the CO2 side, but also on the governance side, and uncertainty as how to operate in that environment, or how they'll be allowed to operate, and uncertainty in terms of what the impact might be on the free cash flow, on the margins of the business. And the point I was making is traditional valuation models, they look at geology, they look at price, they look at cost, they look at grades. They don't look at any of these risks that are being highlighted as the ones with the most uncertainty. And therefore, if you just focus on the valuation models that worked 2, 3, 5 years ago, you may miss some of these new risks, which are still unknown. But if I give you a couple of concrete examples, if you take Canadian aluminum sector, on a global basis, on a pure cost perspective, they are relatively competitive, but they're not necessarily the most competitive sources of aluminum for the world. If you put a relatively small CO2 cost onto Middle Eastern smelters, which are mainly driven by natural gas, or Chinese smelters that are mainly driven by coal, actually the hydro-based smelters become some of the most competitive in the world. And that may well be something that gives Canadian aluminum access to premium markets, the premium brands that start to be worried about their environmental footprint. It may well be that it gives access to premium markets. So, who's to say there's not a scenario where the EU or other markets start to restrict higher carbon footprint sources of metal, or it may be that there becomes a premium for that metal. So there's opportunities, but on the flip side, if you're currently not looking at the risks associated holding a high carbon content metal or stock, or looking at the jurisdictional issues that may well stop your material flowing into one of these big consumer regions. They're just things I think that need to be looked at in your portfolio going forward.
Yeah, thank you for that explanation. That makes a lot of sense, and it's really interesting. I do think that, you're mentioning the concern that investors have about ESG. I wondered, are there ways at this point where people can look at their investments and try to understand if a company is doing a good job in relation to ESG? Do we have any kind of parameters around that, or are we on our way to reaching that point?
So I think the companies are making a lot of efforts now. So depending on your, the bigger mining companies, they've all got ESG reports now. They're all looking to see, to measure their carbon footprint and their governance issues as well. I think the advice I'd give there is you really do need to drill down on an asset by asset basis. So if there's a fleet of low carbon or jurisdiction friendly assets, but there's just one in that portfolio, which may be susceptible in some way. Again, you've got to take your own views on the risks associated with it, but don't underestimate the ability of an event happening to one asset within that portfolio impacting the whole value from your perspective. And we only need to look at events in recent times, whether it's iron ore in Australia or iron ore in South America and Brazil, where an event has impacted the entire portfolio. I think the other thing to is just to start getting your head around, as I say, is just trying to put your own mechanisms together to understand the environmental footprint on a relative basis within each sector. So we're not going to stop needing these metals, particularly those with battery materials, particularly those that are helping that energy transition. So I think it's looking at it within each metal, but trying to get an understanding of where on that sort of carbon curve or where on that governance curve your particular exposure is, and therefore scenario plan what might happen if trade restrictions take place, or if there was suddenly a some sort of price or some sort of restriction on particularly high carbon materials.
Okay, very interesting. That is all that I have for today, unless there are any final thoughts that you wanted to leave the audience with.
So the final thoughts, I have got one final thought. The final thought: as an industry, we've attracted a lot of interest, a lot of capital, and a lot of funding over the last 12 to 15 months. And the industry has performed really well. And, it's shown that capital discipline actually helps in terms of bringing that interest and making decent returns for its investors. So I think as investors, I'd say if you're new to the sector, continue to do the homework. There are long-term opportunities within the metals and mining sector that are worth sticking around for. I think as other stakeholders in the sector, I think there's a challenge for us, an opportunity, which is how do we now retain this wider pool of interest in our sector? What do we need to do to ensure that that we remain a sector which is investable, and a sector that is that can grow and can help with the carbon and energy transition challenges that we face as a world. And let's slip back into old habits once the economy recovers.
Okay, I think that's a great point to end on. Thank you so much for being here today to talk about the commodities sector.
No worries, and look forward to seeing you face to face next year, Charlotte.
Hopefully next year. Fingers crossed.
Yeah.
Once again, I'm Charlotte McLeod with the Investing News Network, and this is Paul Robinson of CRU Group.